Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for February 3rd, 2018. Market remains in bullish volatile conditions. On an annual basis, looking at the weekly RSI 14, we are at 67 out of 100, so neutral. And on a 10-day basis, using the 10-day NDX, we are deeply oversold. In the market mosaic, price with respect to the 200-day moving average is still green bullish at 8.79%, and the slope of the 50 is still green bullish at 0.78%. The ADX remains a strong 46.5 bullish, but that's going to change, I think, pretty soon once the selling pressure of the last 2 days gets factored in. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. That reads at 0.841 right now, deeply into risk off. We take that number and look back 5,000 trading days and find the standard deviation and average in order to compute the risk z-score, and that's at minus 1.90. So it is almost 2 standard deviations below the long-term average. This is a 90-day time series of that indicator, and you can see the collapse of the last week to 10 days as volatility has increased. This indicator gave us excellent warning with the descending highs. The second rise couldn't even get to 0.5 SD before it rolled over, and so we had almost 10 days of heads up over these volatility events. This has been a great time to be preserving swing profits from January and to take advantage of short-term intraday volatility spikes, which is what we've done. The blended monthly rebalancing portfolios for February are noted here. These are the leading symbols for the different populations based on closing prices on Friday. Theoretical exposure in ETF2 remains at 100%. Just taking a quick look at some blended monthly rebalancing portfolio stats. Notice that everything lost money this week, and Latin America, Australia, and real estate were the big winners by losing the least, and that's why they're in the green, even though they were negative for the week. Biggest loser, emerging markets at minus 4%. Latin America and the Dow still holding up the best. In ETF 32, again, some punishment here all across the board. Big losers, materials, energy, healthcare, and emerging markets. The smallest losers, if you will, treasuries, emerging market bonds. Agriculture was actually up 0.32. And utilities, one of the least losers, despite being red across the board in all the other time percentages. I just feel like people are going to be hunting yield in utilities at some point here with a over 10% sell-off from its swing high. In the Dow 30, Boeing, one of the few to actually have a positive week. The other winners, United Tech, Travelers, and Nike, even they were in losing conditions. United Health, Intel, Pfizer, and Chevron, and DuPont suffering. Among the sector spiders, biggest winners in terms of losing the least, banks, telecom, real estate, and utilities. Biggest losers, retail, metals and mining, and oil and gas. ETF Max, these are the leaders from a population of about 500 ETFs. Oil survived. Nickel, regional banks. And then again, you see that the big winners all suffered, I think, some profit-taking pressure here. South Africa, S&P retail, energy, and metals and mining. This is the market health check. I've added just a visual reference of a 5% sell-off in yellow, and then a 10% sell-off in red in terms of price levels from the swing high. You can see the vertical blue lines are 10, 20, and 30 days. Look back here, 60. Horizontal red lines are support levels that used to be resistance and which act as price targets on the way down. Price has now collapsed through three of these at 285, 82, and 76 and a half to come all the way back to the Bollinger Band mean. After extended run-ups like this, that is the least surprising move. It's a little surprising to get it all in one day. But this looks like the Nicholas Taleb Black Swan kind of event where you have every day the turkey is gaining a little bit, and then on Thanksgiving Day, nothing in his previous experience prepares him for that shock of Thanksgiving Day. But I just want you to notice that the risk Z started giving us warnings right around in this region, early and mid January, as the volatility began to increase, and then price rolled over. You have the RLCO outside the river. You have the big dragon rolled over. The slope of the 30 rolled over here 1, 2, 3, 4, 5 days early at a point after a steepness of 0.76, which is extremely good. 0.4 is really the boundary between normal and abnormal. And so all of this price action in the last 20 days has given us a steepness in the 30-period regression line that was extraordinary. And so now we've reverted back to the mean, and now we get to test the buy-on dip opportunity, which we haven't seen for over 4 months. I want you to also notice that the MACD histogram gave us a crossover at a very high level back here, basically where the slope of that 30 regression line rolled over. So again, giving us plenty of warnings that after 1, 2, 3 long side signals, it gave us the warning right in here. So trust those indicators. This is shown as a percent price oscillator, but it works the same way. So traditionally, a 10% pull-off has been considered a correction. In the last 10 years, my spider sense tells me that the folks get nervous at 5%. So I still think we're on the border of a really sharp series of volatility days for this next week, as this is really the first test in the last over 5 months of market resiliency. So let's see what happens. I think the short-term traders are going to continue to benefit by intraday directionality. I want you to notice that in all of these increasing range days, how much of that daily candle is signal rather than noise. In other words, you get large real bodies and small tails. So the intraday moves have been very directional, and that favors the prepared turbo trader who can build on swing signals from our core positions. So I'm optimistic for short-term trading. I'm cautiously optimistic about the resilience of the bull. 7 times out of 10, this 10% correction is a rebound, and a channeling signal is a rebound. So I will be ready to start buying back into new strength as it shows up. The interesting thing will be to see if the old relative strength leaders, like healthcare, will continue to lead out of this blip, or will there be a cycling to a new set of relative strength leaders? And that's what we'll be on the lookout for. ETF2, the regional report, everything is still on a buy signal, so we're still at 100% invested. The S&P at 46 is stronger than the EFA at 38, so it's the U.S. over the globals. Inside the U.S., it is technology, then large caps, then mid caps, then small caps. Two strongest sectors are Latin America at 60 and U.S. tech at 50, and the two weakest sectors are Asia less Japan and the Euro 350. So utilities have just been slaughtered, which makes me interested in them for long-term positions. I'll go over trade frames with the advanced swing course, folks, as we look at a longer-term strategy. I started buying initial positions on Friday to start getting my feet wet as I build a long-term position there. World market model, all of the alternatives have been crushed, and so it may be time for them to resume a leadership role as the equities will begin to suffer here based on Friday's sell-off. U.S. mostly above average, Dow exceptionally so. Latin America and Brazil really doing well. The ETF top 30 based on our ETF2 lens. Green and white are the signals for newly emerging leaders in relative strength. So that would be Brazil, emerging markets, dividends, Indonesia. Latin America is green and yellow. That's a really remarkable bounce. White and green are the ones that are relative strength leaders that are losing steam, so that would be financials and the Dow. And ETF liquidity, these are the ones that are both extremely liquid and extremely volatile here in the green. Shifting to the daily report, everything fired in channeling and overreaction, and so that's a cautionary tale. That's not a signal for taking that many positions. What it tells you is that the entire market collapsed together, and this is an example of how diversified indexes during bull markets can quickly change their correlation coefficient and all go down together. So when you're checking diversification, you should be looking at things that are diversified during sell-offs and not diversified during gains. The 10-day max pain and min pains, these are the ones that have lost the least and lost the most on a percentage basis from their 10-day high. And so I usually like to look at the 10-day max pain. So Chevron, GE, Intel, Caterpillar, and Procter & Gamble in the Dow. Many signals to choose from. Most of them testing out well on the auto framer. Not surprising, as a test of the 10-day high is the upside target. And you have plenty to choose from. One frog candidate here in Procter & Gamble at 3.0. Lots of RSI2, short-term washout patterns. I will resume the NDX. I was able to fix the code late last night after I published the report to sort out the problems with the NDX. Big losers on the 1 day noted in red. The least losers, not really any big winners, but the least losers: Pfizer, 3M, Walmart, and Nike. In the ATF 30s, again, plenty of channeling and overreactions to choose from, lots of 551Ws, and plenty in the auto framer. Again, this is a market that all went down together. Oops. Daily pinch and stretch. You notice now that we've mostly come out of the green for the most positive Z stretches based on that sell-off. Even Boeing has come back to be only slightly above that Bollinger Band mean. Travelers is one that we definitely are going to frame. That held up really well during the sell-off this week. Conversely, the most negative Z stretches, these are the ones that led the way to the downside, and you can see how far below their Bollinger Band mean they are. The most expanded pinch boxes, these are the largest directional moves on the basis of Z-score, and no super pinches based on the sharp directional move. So what happens is super pinches occur prior to those kinds of moves, and the tightest compressions quite often lead to the biggest expansions, such as in Apple and Boeing. Lots to choose from in the auto framer, no squeezes. You can see in the market mosaic that sharp sell-off. The crossover occurred well above 2 standard deviations above the long-term average, and so that is a good possibility of a change in the swing regime. Even the stretch of the RL30, again, you see in the long-term price pattern here of the last 30 days, and then the stretch above the 200-day moving average came all the way back to just plus 1 SD above the long-term average. So a great leveling. We've been talking for almost 2 weeks now about this anomaly of all 3 of the regression lines, the 10, the 30, and the 90, all outside of the 1.0 river. And you can see we've pulled all the way back to the Bollinger Band mean in the middle of that river, which brings it back in line with just a normal bull. And so now this is what we've seen. Was this just a return to the projected fair value? Is this the beginning of a worrisome move that would take us back to 265, 255, 245? And we shall see. That 1 day loss in the S&P was a -2 sigma move. Being down 3.8% over the last 5 days is a -2 sigma move. The loss of 2.5% over the last 10 days is a -1 sigma move, etc. And that's everything I want to cover. Just flash through the reference files for you. These signal to noise ratios, just notice the things that have been very, very directional. Intraday, large real bodies, these become nice trading candidates. Emerging markets, metals and mining, energy, Mexico, Boeing, and real estate. Latin America is the sole healthy index out there among all the usual suspects. Resisted the losses the most, with the exception of gold and Microsoft, and is actually still positive, exceptionally so over the last 40 days. And that's our weekend report. Keep your risk measured and your powder dry.